I had friends who were good, hardworking, worked at hedge funds, and the good, hardworking people in other industries were making $200,000 to $2 million a year, and they were making $20 to $30 million a year. And then that came to an end, or it's slowly but surely, I would say the majority of them are even out of the business over the last 5 or 10 years. They've stayed in the business, but their AUM's gone from, 3 billion to 300 million. And my thesis is that the alternative investment sector could best be described, that's mutual funds, hedge funds, as San Francisco real estate, and that is expensive but bad. And that is, the returns have been in stocks that everybody knows, so no one's going to pay you 2 and 20 to buy NVIDIA. And they've been left trying to find alpha in a narrow part of the market, and they've just vastly underperformed. I think the analysis shows if you added up all the people on CNBC who come on and pitch stocks, they have underperformed the S&P by the amount of their fees. Isn't this arguably one of the biggest grifts in economic history, the alternative investment community?
The Financial Times called a hedge fund a scheme to transfer money from naive investors to savvy managers. And I think that overstates it a little bit. The golden age of hedge funds was pre-Reg FD, where you could have an information edge, and before quants were really everywhere, to say nothing of the few quants that really put up killer numbers in the 80s, 90s, and 2000s, right up to the financial crisis. Jim Chanos has a wonderful quote in the book. When he started in the 1980s, there were 100 hedge funds, and they all create alpha. Today, there's 11,000 hedge funds, and more or less those same 100 are the ones that generate alpha. So my thinking on alternatives has evolved. If you could get into the elite hedge funds, the top, let's call it decile, the D.E. Shaws of the world, if they're willing to take your money, and it's their money-making fund, not their secondary any hedge fund that's successful always rolls out a plan B for the masses, and it never does as beautifully as the first one does. Yeah, that's a great opportunity. What we've seen since the financial crisis and the era of zero interest rate has been a shift in assets. Instead of flowing into hedge funds, and they're still going in to some degree, it's $3 trillion, they have moved to private credit and private equity. And that seems to be the alternative that, if not generating alpha over and above what the market does, at least they can make a plausible case that it's not correlated and it's diversified. We're not putting money into publicly traded stocks. We're not putting money into bonds. We are buying credit and or private companies, and therefore under exposed to the equity markets. At least that's a plausible argument. I'm not so sure I fully buy into all of it, but it's a better argument than I'm going to aggressively trade on a leverage basis public equities.
I still can't help but stock pick, and I want to put a couple of my core theses out there and have you respond to them. One is regarding what you said about Europe. And every year, at the end of the year, I make a bunch of predictions. So one of my predictions in November of 2024 was that we were finally going to see the flows, the rivers reverse. And that is, someone told me that if you added in debt, the U.S. market accounted for 70% of the world's value. That it was just, if it's just equities, it's 50%, but if you add in debt, the total value of the world, if you put a price tag on it, is represented, 70% of that is the U.S. And I thought, okay, if I could buy the U.S. for $70 or the rest of the world for $30, I would buy the rest of the world for $30. And so I've started rotating out of U.S. growth and into value, some in LATAM, some in China, and some in Europe. And I read that U.S. growth is at 98%, meaning on a scale of 1 to 100, it's only been more expensive 2% of its history. And this is about a month old, so I'm sure it's changed, but European value was at 2%, meaning 98% of its history it had been higher. So granted, this is just stock picking on a more meta level, but doesn't the U.S. just generally speaking, and I'm curious if you're telling your clients this, just look overvalued?
So let's start 30,000 feet and drill down. First, you have that itch, and the advice we always give people with that itch is set up a separate cowboy account, put 5 or 10% of your money into it, and pick stocks to your heart's delight. Who cares?
That's
But
no
leave your
fun. I do 30, 5 to 10%.
All right. Well, you're risking another 2000 and 08, 09. If you blow up 5 or 10%, who cares? It hurts, but it's not fatal. So that's number one. Number two, sometimes stocks are expensive or cheap for a reason. You could look back for the past 15 years, other than really briefly after the financial crisis. It's hard to say U.S. stocks have been cheap anytime in the past 10, 15 years.